All right, so we're here with another Friday podcast. We have Dustin in the building, ready to go. Dustin, say hello.
How's it going out there?
So Dustin's kind of lost his voice, but it sounds quite comical, and I made him do this. I wanted to say, hey, man, I'm taking the show here today, but you're joining me. You're joining me.
I don't know if you can still say it, but mama don't raise no. No, probably not.
Please, edit that, please. Jeez.
It's your show today, man.
So, all right. So we want to talk about the impact of market performance on retirement savings. That's really what I want to hit home on today. But before I do that, I've got something for you.
Ooh.
I got a little email that we got that came from a client.
It's a good one, right? Finally.
Well, the thing is you've had some videos over there coughing in the mic, so bear with them. I just appreciate you being here. Really do. So the email comes from a client that mentioned that they watched the Jazz After Dark show. So if you haven't caught that, little plug.
Nice. Very nice.
So you've been kind of talking a bit about millennials here recently on there, and on that you mentioned that you are a millennial.
Yeah.
Okay.
I'm not proud of it, but
well, they said they wanted to break the news, but they wanted me to break it to you that you aren't just a millennial.
Uh-oh.
You're a special class.
What does that mean? So
it means that you are what
half
is
and half?
considered a geriatric millennial.
Oh, Jesus. Well, you know what, though? I'll take it.
Okay, well, that's what they said. They said, so if you're born between 80 and 85, then you're either going to be hurt or relieved. So one of the two. So you're not a true millennial. You're a geriatric millennial.
I don't mind.
All right.
Put me in that millennial camp, man, with some of these. So I'm half and half is what you're saying.
Yeah.
Ooh.
But, I better get into it before somebody leaves another comment letting us know that this is becoming a bro show or something.
Oh, damn bro shows, man. Come on, man.
All right, so impact of market performance on retirement savings. It's hard for me to drink my whole cup of coffee during this show.
You got it.
Because I have to talk the whole time because I get like 3 words out of you.
You want me to do a plug? Jazz After Dark, man.
There you go. This is just weird.
Yeah.
Maybe don't talk.
Okay.
All right. So the idea is what I did was I took the SPX and then I took AGG as far as just a bond fund.
I see what you're saying.
SPX is the S&P 500. AGG, we're looking at just a general bond fund and really looking at if we went with a 90-10 there or a 70-30 or a 50-50. Now, there's a lot that will come into play with why you would choose different types of investment elections.
Yeah.
But this really is primarily a focus for the younger person, but then at the same time, you have to think through it for the older person that maybe you're retired now and you have different buckets. If you go too conservative with all of your money, what that could do. Well, at least we know your phone still works.
Yeah.
So even though your voice doesn't.
I'm sorry, man. I'm sorry.
All right. Man, we're going to get through this show. We're going to get through it. It's some good stuff. Bear with me here. Bear with me if you haven't already lost us. So, all right. So if we're looking right here, 1 year performance. So a 90-10 versus 70-30 versus 50-50. It's interesting because there is definitely a difference, but it's not a significant difference because we have to talk about the fact that bonds were horrible in 2022. So if you're looking at this, a lot of people came to the table and they said, hey, we expected a better return because we have more bonds in the portfolio, but it just didn't happen because of rates and where things were and the fact the Fed's raising rates.
First time ever that bonds and stocks actually fell to the same degree so that they were that correlated. That's impressive.
Yep. So that's what you're looking at for a 1 year. But then if we take a look at the 5 year, and what I want to do in a minute is I'll show you each of these and I'm then going to model them out actually and show the differences of how this could affect a portfolio. And so if we're looking here at a 90-10, 70-30 for a 5 year window, look at the differences here for the 5 year. Your 5 year looks to be at 6.57% is your return 5 years. Now that's, we're factoring in though 2022 was a rough year coming down, but you've got a 6.57% return on a 90-10, 5.38 for a 70-30, and 4.04 on a 50-50. Now,
can I point something out? So,
yes, you can.
Because you're going to get this comment. It says level percent change and total return. So whenever we plot the S&P on a chart, it's going to give us both the what if you didn't reinvest dividends, that's the level change,
Yep.
and the total return is if you did invest dividends. Now, when we build a custom portfolio, it doesn't know the dividends that you might have accumulated over the time. So that is, when you see total return not different than level change, it's level change, right? So you technically it could be a little more if you reinvested the dividends.
Well, look at look at you bringing in the knowledge.
Well, I
on
don't
this,
want to
right?
see a comment, you know,
hey, I like it.
misunderstandings.
Yeah, but getting hollering at these people, these comments, and then they'll make it to the mean comments show.
Oh yeah.
So for the 10-year, so,
Excuse me.
so for the 10-year, we'll get you back in here. So the 10-year is interesting though because if we're looking at hypothetical performances, in general, the S&P 500 talk about just over 9, close to 10% roughly is historical performance. The 10-year looks a bit better like that. But we also are factoring in that we're coming out of that 2008 recession going into 2009. So I would rather not use these numbers as much as I would rather use other numbers with this oftentimes. So it all depends, but this is probably your best look at everything.
Well, I would add to it that if you look just after 2020 and you're looking at the beautiful orange line there, when we hit COVID, it's not the greatest view, but look at how the orange line, in simple terms, fell well below and almost caught up to your other portfolios.
Yeah.
So the returns are one thing, but could you handle that type of volatility and essentially a 33% drop? Whereas everything else, look at the bottom line, your 50-50, that barely fell. And that's a poor example of sharing that, but I want to point out volatility as well. It's a big deal, especially when you need to have some safe dollars there.
Yeah, and the control the emotion, and where I'm talking to is, looking at this chart, this is probably the most accurate, but from a planning perspective, we talk through, sometimes we say, hey, you know what, 7% return. That seems to be the go-to number for a lot of people is the 7% return versus a 9.5, because you do have different windows there where you're going to have a less or possibly even a more return there.
Well, and the way they come up with that is lifetime of the market, 7% return is your level change, right? So if you did not invest dividends and there was no inflation, total return is if you reinvested dividends and you have that, obviously, that's where you get closer to 9.9%, which is everybody says. So if we ever put 9.9% for returns, you got to know we're not trying to juice the numbers. That's, reinvesting dividends and, of course, not accounting for inflation. You wouldn't do that, though.
I like this mellow Dustin.
You know what I'm talking about.
Thank you for
By the way, I love those colors you picked on that chart.
All right.
Those are beautiful colors.
All right.
Man.
Look at me, even with a different shirt on today. You're talking about colors. I just realized that I didn't put my Doe Straight shirt on.
Well, Eric's always known for being a little bright. Now you know. You don't have to play the game.
Right. All right. So then if we take it here, we look at actually the breakdown of everything. So if I'm looking at this chart, what I am looking at here is, again, what I did was I wanted to show the differences from a bigger impact. I looked at the 10-year returns because that's the most accurate, even though, as I mentioned, the planning side, sometimes we're looking at 7% only. And so if we're looking here at, let's just say you got a 9% return on your money, this is our planner tool. Now, what we're looking at with this, though, and you see this massive drop-off, I'm not worried about modeling anything from a retirement perspective. All that I'm wanting to model on this is where would the money be? So if you were a 35-year-old and you retired at 60, it's basically 25 years compound interest of you investing and getting a 9% return, and you started with $150,000. That's where you're going to start. You're not going to put any more dollars in. You would have $1,293,462 at age 59 before you started that retirement at age 60. Now, if we flip this, though, so what I did was I built in different scenarios. Let's say you only got a 6.6% return. If you only got a 6.6% return, it completely changes everything because now your $1,264,000 is only $736,000. Not quite, but almost half.
Yeah, that's huge there. And I like what you did because we're using the planner not really just to justify returns, right? What is the difference in returns? I had not thought to do it that way.
Yeah. And
Well done.
and so then again, we're looking here. So we've got differences there. If you only got let me pull this up. So if you got a 5.4% return, you're looking at, your total assets there of, I'm trying to get this so hopefully Cody can pull this up and show it for everybody. 555,000. And then your final one here, scenario 3, I think we've got one more, is at 4%. So if you go crazy conservative, you would only have 403,000. And that goes for those that are ultra conservative, especially right now in the markets, and are a little bit concerned with where you're at, and maybe you're trying to play it safe completely. What's going to happen is you're going to miss out on the large upswing if you went conservative early, while the market was already falling, and you said, hey, you know what, I'm going to take it all out, and I'm going to put it in something safe and get a 3%, 4% return, maybe put it in the bank. If that's what you did, you're going to miss that large upswing, and so your averages are always going to be lower because you pulled out when the market was falling. Yep. So that's really what I wanted to show on this, because it is all going to depend. It's a bucket strategy. If you're in retirement, maybe you don't need to be all 90-10, but at the same time, you're going to be very thankful for the sake of maybe we do some of that for the long-term stretch, but then some of the other money can be adjusted for a bit more or a bit less aggressive that's going to get that shorter return for you.
I would add to it that if you're one of our clients and you look at our recent classes there, we talked about how long does the market stay at a bottom. So let's say the market's falling and you're like, that's it, get me safer, I want to do something safer. How long does it actually stay at that bottom? The average over the entire life of the market is 14 days. So if you go to our last Wine and Wealth class, you can actually see it. But the shortest was during COVID. It spent 2 days within 5% of the lows. So if you tell yourself, I'm going to just go a little bit safer for a while, you better have really, really accurate timing to get back into the market. And now you're kind of asking yourself, how quick can you be? By the way, the decline after that, during the financial crisis, we spent 5 days within 5% of the absolute bottom. So if you didn't get in during those 5 days, the famous call from the guy on CNBC who's since passed but nailed the actual bottom intraday, you better be quick, right? So this whole concept of slowing performance down on the way down, horrible idea.
No, I agree. Well, I think it's about the time that you go get some rest.
Oh,
so,
I can do that.
I don't know if we got the coffee flip in there or not. We got it on. We've got multiple cameras going in here.
Yeah, you always get the coffee flip.
Getting crazy, We got cameras up here. I asked Cody, I said, where do I look again? I'm getting kind of confused. But
I need something now. I need a deal.
You do.
Get your dough straight.
Get your dough straight. That's it.
I love it.
Well, for everybody that kind of bared with us, Dustin's a little sick. I appreciate him joining and staying with us there, and for everybody else that stuck it out. So thank you. And next week we'll be back, hopefully all healthy, ready to go, and we'll have another good show for you.
You did a great job, baby. Great job.